The information in this course, Getting Started with Financial Ratio Analysis, helps you understand why financial accounting rules are so nitpicky. Properly classifying accounting transactions is key for financial analysis users, which is the topic of this course. Here, you learn about key measurements and analysis that financial statement users perform to gauge the effectiveness and efficiency of the way management is running the company. Three major ratios categories are a company's liquidity, profitability, and activity. You may assume that all investors care about is how profitable a company is, but that's not necessarily true. Liquidity, which indicates how well a company can cover its short-term debt, and activity, which shows how well a company uses its assets to generate sales, have to be considered along with profitability to form a complete picture of how well the business is performing. Wrapping up this course, you find out about horizontal and vertical analyses of the income statement, which is an excellent way to zoom in on profitability issues. Liquidity is a company's ability to free up cash to meet its business obligations. Liquidity measurements reflect a company's ability to meet its short-term obligations. These measurements are important because a company that can't pay its bills in the short term more than likely has going concern problems. The phrase going concern means the company is likely to continue in business for at least 12 months beyond the date of the balance statement. If a company has going concern problems, you can't be certain it's going to stay in business for very long. The accounts you use to measure liquidity are taken from the balance sheet. Because liquidity is concerned with the short run, the accounts you use for these measurements are all current rather than long-term. Later in this section, we talk about trend analysis, which is looking at ratios over a period of years. Trend analysis isn't normally applicable to liquidity measurements because when it comes to liquidity, financial statement users are looking at what's going on in the short term, not over a long period of time. Your financial accounting textbook discusses three principal evaluations to measure liquidity: current ratio, acid test ratio, and working capital. You express working capital as a dollar amount. These measurements are all easier to understand if you use account balances to work through them, so let's get to work computing some figures. You find a company's current ratio by dividing its current assets by its current liabilities. Here are some quick examples of each. Number 1, current assets, accounts such as cash, accounts receivable, merchandise inventory, and short-term investments. Number 2, current liabilities, accounts payable, and all other debt that is due within 12 months of the balance sheet date, such as accrued payroll, which is wages employees have earned but not yet been paid. The current ratio tells you a lot about how liquid a company is because current assets are either cash or are easily converted to cash in the short term. In theory, they can be used to pay the short-term obligations. Being able to meet short-term obligations is crucial to a company remaining a going concern. In addition to having a handle on how well a company covers its current debt with current assets, just about all financial statement users want to be able to evaluate the relative robustness of a company's income over a series of years or financial periods. Looking at a company's performance over a long period of time is called trend analysis. Trend analysis is a single profitability measure standing alone, doesn't really tell you much about a company or how it is performing compared to its competition. This is true for two reasons. Number 1, the company may have had an exceptionally good or bad year. Unless a company's performance is static from year to year, looking at only one set of figures gives the financial statement user an inaccurate vision of the company as a whole. Number 2, under generally accepted accounting principles, GAAP, companies are allowed to use various methods to estimate some expenses. If a financial statement user is trying to compare company A to company B by using a single set of profitability ratios, he's not going to see the whole picture. Trend analysis gives much more meaningful information to the financial statement user because differences in accounting methods tend to smooth out over time. For example, while which method a company uses for depreciation affects the amount of depreciation expense by year, it never affects historic original cost. Using trend analysis means looking at profitability ratios over a number of years. Doing so is usually more helpful to the financial statement user than any single ratio is because everything is relative. Seeing how profitability ratios go up and down when comparing current performance to past performance and when comparing the company with other companies in the same industry is more meaningful than just looking at one standalone ratio. Most investors consider at least 5 years, sometimes up to 10. Return on investment is a measuring tool investors use to see how well their investment in a particular company is faring and to help them make that important decision to sell a stock and move on or to stick with it. Potential investors also use return on investment when trying to make a decision among different companies in which to plunk their spare cash. Basically, investors want to see how well company management is using the company assets to make money. This information gives the investor some idea of the competency of management and the relative profitability of a business when compared to others the investor is considering. Investors can calculate return on investment, which is expressed as a percentage, a few different ways. All the methods involve using some form of comparing income to assets. Here are two methods your financial accounting textbook most likely illustrates. Number 1. Net income divided by average total assets. Net income is the bottom line total of what's left over after you deduct all business expenses and losses from all revenue and gains for the same financial period. In a nutshell, they are all the resources a company owns. Number 2. Operating income divided by average operating assets. This form of return on investment calculation starts with income before income taxes and interest and divides it by average operating assets, which are long-lived assets such as property, plant, and equipment. Return on equity measures the profit earned for each dollar invested in a company's stock. You figure it by dividing net income by average owner's equity, which is what's left over in the business after all liabilities are subtracted from all assets. The higher the return on equity ratio, the more efficient management of the company is at utilizing its equity base. This measurement is important to stockholders and potential investors because it compares earnings to owners' investments. Particularly because it takes into account retained earnings, the company's cumulative net income fewer dividends. It gives the investors much needed data as to how effectively their capital is being used. Having net income growth in relation to increases in equity presents a picture of a well-run business. In this section, we discuss activity measures that quantify the relationship between a company's assets and sales. Your financial accounting textbook probably mentions a few activity measures. In this section, we discuss the ones most commonly used. Those measuring accounts receivable and inventory activity. Number 1. Accounts receivable turnover. This measurement shows the average number of times accounts receivable is turned over, that is, booked and paid, during the financial period. The sooner a company collects receivables from its customers, the sooner the cash is available to take care of the needs of the business. Why is this rate such a big deal? Well, the more cash the company brings in from operations, the less it has to borrow for timely payment of its liabilities. Number 2. Inventory turnover. This activity measure shows how efficiently the company is handling inventory management and replenishment. The less inventory a company keeps on hand, the lower the costs are to store and hold it, thus lowering the cost of inventory having to be financed with debtor owner's equity, the ownership rights left over after deducting liabilities. However, keep in mind that running out of inventory is not a beautiful thing either. Depleting inventory could cause a company to deliver an order late to a customer and perhaps strain the company's relationship with the customer. Also, running low on inventory may cause the company to panic and buy the same inventory for a higher price to get it right now. Too much of that sort of hilarity can play havoc with the bottom line.